Rob Arnott's approach to indexing has elicited some very strong reactions from some of his peers. John Bogle, founder of Vanguard and one of Rob's heroes, has denounced it as witchcraft. A professor at University of Chicago has said that Arnott's success is a triumph of marketing rather than an innovation in investing. Well, the numbers, however, paint a different picture. You can take a look here. Here's a 5-year performance chart of Arnott's flagship index fund compared to Vanguard's. And you can see it's about a 1.8%. That's an annualized equivalent yield, so over 5 years that adds up to about 10%. He's also not wanting for some well-heeled clients. Here's a very short list of some of the big names who are partners as well as investors. So why the controversy around his methodology? Well, why don't we ask Rob himself? He is joining us now live from Irvine, California. Rob, great to have you on as a guest. And there is some controversy surrounding what is otherwise, most people would say indexing is not so controversial. So why don't you tell us a little bit about the methodology and why it's attracted so much attention?
Sure, and thanks for reaching out to ask the question. Firstly, what is fundamental index? Basically, instead of weighting companies in a portfolio in direct proportion to the market capitalization, and hence in direct proportion to the popularity of the company, we weight in terms of the size of a company's business. And we use that as an anchor to contra-trade against the market's constantly changing expectations. By weighting companies in accordance with their size in the macroeconomy, we wind up with a portfolio that mirrors the look and feel of the economy. Weighting companies based on book value, based on cash flow, based on sales and dividends. And in so doing, we wind up with a portfolio that does not chase fads, bubbles, crashes, and the market's constantly shifting expectations. And I think the results speak for themselves. The idea has been live now for over 5 years. What we've found is that it's added 2 to 4% all over the world, and it's gained adoption fairly quickly. The idea has gone just in the last year from 29 billion to about 55 billion in assets that employ fundamental index as a core part of their investment process.
Now, some would argue that the fundamental index actually takes on significantly more risk, so perhaps those extra returns are just commensurate with the amount of risk. What do you say to that?
Well, empirically, what it does is take on discomfort, not necessarily risk. What we do is we buy into whatever is most newly out of favor and sell what is most newly popular, trendy, and comfortable. Well, the markets don't reward comfort. And so the pattern of trading is fairly uncomfortable. You're bailing out of whatever's popular, trendy, and comfortable and buying into whatever's newly feared and loathed. And of course, some of those are justly feared and loathed.
How do you know? I mean, this is the $1 million or perhaps $1 billion question. How do you time when something is at its high and when something is about to be at its low? Isn't that the age-old question?
Well, this doesn't seek to time tops and bottoms. What this does is it seeks to use the size of the company's business as an anchor so that as the price goes up and down in response to changing expectations in the marketplace, you wind up rebalancing to the economic footprint of the company. So that means that if a company is expensive, you're going to trim holdings back to the economic footprint. If it becomes more expensive, you'll trim more. It doesn't pick tops and bottoms.
Rob, could you give us an example, perhaps maybe a very simple one, of how a passive index would work? Typically, they're market capitalization weighted versus how your model would actually approach trading, because many people would say that, you know, you're no different than a good stock picker, perhaps, or perhaps another quantitative fund that uses its own particular metrics.
Well, firstly, I would agree that this idea is not necessarily any better than a really good stock picker or a really good quantitative method. The beauty of it is its simplicity. Let's take Apple as an example. Apple is traded as the second largest market capitalization company on the planet. That means that the market is pricing Apple to reflect an expectation that its growth in the years ahead will deliver second largest profit stream to the shareholders of any company on the planet. Fundamental index says, well, fine, but that's in the price. You're already prepaying for that future success. If the success doesn't measure up to those lofty expectations, you'll have overpaid. So we'll just rebalance it back down to its economic footprint, which is about 50th largest on the planet.
Rob, let's turn now to bond investing. That's an area you're going to focus on going forward.
This idea works in lots of different asset classes. It works in real estate through REITs, it works in bonds, it can work in a lot of different areas. And one of the more exciting new developments is taking fundamental index into the bond arena. If you're a bond investor, you're a lender. And so why on earth do you want to invest cap weighted, which means that you're going to be putting more money into whoever's most deeply in debt? The very principle of cap weighting in bonds makes no sense. You're winding up putting most of your money in the companies or countries that are most deeply in debt, and if they want to borrow more, with cap weighting you're required to lend them more. Well, what's the sense in that? Why not weight companies and countries in accordance with their ability to service debt, with their financial footprint rather than their debt footprint?
That certainly makes sense. It seems to me that mortgage lenders do exactly that with individual homeowners. Well, Rob, we appreciate you joining the show and shedding some light on your strategy there. And good luck to you with your new funds and your focus on bond investing. Thanks so much for joining us.
Thank you very much.